that if you believe we're going to have irresponsible monetary policy and inflation going forward, if it's in a bull phase, you want to own Bitcoin.
In this interview, Stanley Druckenmiller talks about his Bitcoin trading strategies. He talked about the best time to invest in cryptos and when you should strictly stay away from the market. He also spoke about recession and the short-term future trajectory of the stock market. Also, I'd just like to remind you that we're giving away $100 to a random subscriber at the end of this month. To participate in it, you must subscribe to our channel, turn on post notifications, like this video, and leave a comment in the comments section below. Good luck. Now, let's look at his interview.
Well, that's what history says. There's an interesting historical fact, which in fact I think is going to be violated, but two undefeated records are: number one, once inflation gets above 5%, it's never come down unless Fed funds have gotten above the CPI. Well, since the CPI is 8, that would call for a Fed funds rate of above 8. Frankly, I don't think we'll get there because the extent of the asset bubble and the damage that would be done. Think about the fact that we have virtually no bankruptcies, and look at probably the most disruptive period since the 1890s. I don't need to tell a founder of Stripe that, but if you look across the landscape, there should have been many, many, many bankruptcies which have been buried by QE. So if in fact Fed funds ever got to 8%, which by the way, I don't think is going to happen, the destruction would be quite material. The other statistical fact is once inflation's got above 5%, to use your word, it's never been tamed without a recession. So if you're predicting a soft landing, you're going against decades of history. Could happen, anything's possible, but I don't think it's probable. And the CPI is currently 8 year over year. I actually think we are going to violate history and it is going to come down. I don't know how far, but without that happening, the second one, I think history is going to win. That's once inflation gets about 5%. It's never come down without a recession, and I think a recession is in the cards. I just don't know when. We have about, depending on who you listen to, $1.5 trillion to $2 trillion of excess savings now. So it may take some time to work through that savings, but given the extent of the asset bubble and the destruction in the markets, given what's going on in Ukraine, given zero COVID policy in China, I don't take a lot of comfort from that. So I assume, and I pretty strongly assume, we're going to have a recession sometime in 23. I just don't know whether it's going to be in the early part or the later part. And again, it's a guess, it's not a fact. Yeah, one of the ironies of my style, maybe it's because I was a dropout of a PhD program in economics at the University of Michigan, is that I don't use what traditional economists use to predict the economy, which is things like employment and a bunch of macro top-down statistics. In fact, I started my career as a bank and a chemical analyst, and over time I learned that the inside of the stock market had a very, very prescient message about future economic activity. And for whatever reason, stocks tend to lead the fundamentals by somewhere between 6 and 12 months. And you can even go beyond that and look at industries that lead the economy and industries that lag the economy. The obvious one that everyone knows about is housing, has traditionally been looked at as a leading industry. Retail has a slight lead, capital goods lag. And what we've done historically is actually, even though you refer to me as a macro investor, and many people have, is we do the macro by a compilation of listening to companies and doing a bottoms-up analysis of companies that lead the economy industries that lead the economy and industries that lag the economy. And if the leading industries are turning up or turning down, that's a signal. And that's worked beautifully historically. The other signal, which I have found quite prescient for markets, is the bond market. Um, Unfortunately, the last 10 or 11 years, the bond market has not signaled anything because the central banks took it upon themselves to manipulate bond prices, which to me is the 10-year treasury has sort of been the most important price in the world. And they took that price out of the equation as a signaler. I remember last summer when certain forecasters had a different forecast than my own, kept talking about, well, the bond market is saying this, the bond market is saying that, when the 10-year dropped all the way from 170 to 115, which, by the way, I did not anticipate. But the bond market wasn't saying anything. What was going on is central banks were buying trillions of dollars and manipulating the price of bonds, so there was no signal. I don't think you get that tainting if you look inside the stock market. You could get it in the stock market as a whole, but if you do this approach where you look at industries and which lead, which lag, and you put the puzzle together, it's been prescient over time, and it's certainly allowed us to consistently the last 20 or 30 years outperform the Fed in terms of economic forecasts. I don't know whether I'm seeing it, but I expect it to. You can't build over 2 trillion in wealth in purchasing power and then take 1 trillion of it out and not matter. John, I also have high frequency signals, and there certainly seems to be a strong correlation between crypto and the NASDAQ. I don't think it takes a genius to figure out why. So I'm looking at it as an indicator that way. Crypto, everything that Charlie Munger says about it, I'm sympathetic to. Everything that says Bill Miller says about it, I'm sympathetic to. So I think that's a movie that has yet to be played out, and one that I don't want to bet on in conviction, but I will be very surprised if blockchain isn't a real force in our economy, say 5 years from now to 10 years from now, and not a major disruptor with companies that will have been founded between now and then that'll do very well, but that will also challenge things like our financial companies and do a lot of disruption. So I find crypto interesting. My 69th birthday is in a couple of weeks. I'm probably too old to compete intellectually with the young people in this space, but I'm certainly monitoring it. I think a younger Stan would be diving into everything more energetically than I'm talking to. Age is a funny thing. I feel my predictive power and forecasting power is as good as it's ever been the last 3 to 5 years. But I'm certainly not making 30% net returns per year like when I had clients. So I think it's two things. Yes, I think younger people understand new asset classes better. But B, I'm just not playing anything as aggressively as I used to. I'm not sure why, other than NASDAQ type risk play takers are the ones that tend to play in Bitcoin, and curmudgeons that are gold bugs and want the world to fall apart play in gold. But there's no question, and this I've watched and it's gone on long enough now that I believe it, that if you believe we're going to have irresponsible monetary policy and inflation going forward, if it's in a bull phase, you want to own Bitcoin. But if it's in a bear phase for other assets, you want to own gold. And I think I just articulated the reason, but sometimes, John, I don't care. This has gone long on enough that I'm starting to believe what I'm observing. And for sure, if I think we're going to have an inflationary bull market, I'd want to own Bitcoin more than gold. And if I thought we're going to have a bear market, stagflation type thing, I'd want to own gold. Doesn't mean I'm going to believe that in a year, but that's my assumption going forward from this point.